Amazon, Home Depot, and UPS, companies seeking to streamline their workforces as they deal with challenges from inflation, Fed policy, and AI. Joining me here to discuss this is Laura Ullrich. She is the Director of Economic Research at Indeed. Laura, it is good to see you. So we did hear from the Fed this week. Laura, you heard Jay Powell at that presser, broadly positive about the economy, did talk about signs of stabilization with our labor market. Just based on the data that you have, that you see, Laura, does that generally sort of dovetail with your view of the labor market, signs of stabilization?
Thanks so much for having me. I think yes, but I would say. So if we look at the labor market from a macro sense, we have stabilized, but in this low hire, low fire environment, which, by the way, doesn't feel very good to a lot of job seekers because of that low hire portion of that equation. So if you have a job, the unemployment rate has remained low. And so the probability of becoming unemployed, even with the layoffs you're talking about, still remains pretty low. But if you do become unemployed, it's harder to find a job now.
I would love, Laura, to get your take and your response to Governor Christopher Waller, because he made some news today. I mean, this got attention, explaining his dissent, Laura, right? Why he wanted another cut, actually. Waller does not like what he sees at all with the labor market. He says the unemployment rate has risen since the middle of last year. He talks about payroll gains in 2025 were very weak, he says. Ends here with, this does not remotely look like a healthy labor market. What do you say to Governor Waller there?
I agree with that last part in terms of it doesn't look like a healthy labor market. And let me explain why. Really, if you look at the growth that we saw in the labor market in 2025 and the number of jobs that were added, around 70% of all jobs added in 2025 were in healthcare alone. And so if you're a healthcare worker, our Indeed data shows that if you work in sectors, certainly in healthcare, but also in engineering, also in construction, a few other sectors, the labor market still probably feels pretty good. But in some of the larger sectors like business and professional services, which is a very large sector and lost jobs in 2025 in the payroll employment data, we also see that a lot of positions in that sector are soft. And especially in the tech sector, many tech jobs are soft as well.
Speaking of tech, Laura, what impact is AI having on our labor market right now? And what do you see ahead?
I think it's a great question, and I think it's very hard to answer because I actually see it as three things happening at once. The first is that AI is starting to do some actual work, right? But I don't think there's a large number of AI agents actually taking over human jobs yet. However, we have seen, and the second thing going on, companies have shifted their investment very heavily towards investment in capital, investment in AI technology. And when companies do that, they tend to decrease their investment in labor. And so hiring slows down. I think we've seen that in real ways, and the layoffs that we're seeing are certainly a reflection of that. And then the third thing, I do think that some of this softness in the tech sector and some of the layoffs we see still are about the overhiring that occurred in 21 and 22. These companies have tried to correct for that via attrition or via strict return to office policies, but they're clearly now deciding to lay off workers to get to the size workforce that they need.
One dynamic that's really interesting, Laura, and in fact, Powell was asked about this by our very own Jennifer Schonberger, is this dynamic, Laura. You have this strong economy. I'm just looking at Atlanta Fed GDP, Laura. Estimate 4.2, okay? And yet at the same time, this cool labor market that we're talking about. Mm-hmm. How do we explain that dynamic, and does it continue?
It's very difficult to explain, and therefore my belief is that it doesn't continue for very long. It is very unusual to see hires rates as low as they are right now in a period of time when we are not in a recession. And we very clearly, because of strong economic growth, I don't think it's going to come in quite as high as the Atlanta Fed is probably saying, but it is going to come in relatively strong. And so we would expect to see hires rates and quits rates much higher than they are right now. So it is very unusual to see hires rates as low as they are and layoff rates as low as they are. So something will change. Either companies will realize we've held back hiring for too long and they'll start picking up, and hires will pick up, quits will then pick up. Or we might have a change in the economy, or companies may say, you know what, we are going to have to lay off, and we'll see layoffs go up and unemployment rate climb. And I think that that's a very precarious balance and could certainly go either way depending on a number of factors.
What are the trends in wage growth you're seeing, Laura?
It certainly has slowed down, and that's not a surprise given what we just talked about, right? If people are hugging onto their jobs and if workers aren't leaving, companies, quite frankly, don't have to give them as large of raises, right? They don't have the same incentives to provide those larger wage increases to workers. So they have declined, and it is in line with what I would expect in this sort of labor market.
Finally, Laura, next big jobs report on deck, right? Next Friday morning. You'll be reading through that. What do you expect to see?
My thoughts are that it probably will come in around what consensus is saying right now, which I think is around 60 to 65,000 jobs. So we've seen just these stagnant labor reports over and over and over again. But as I highlighted on a Hiring Lab piece last month, month after month of stagnancy adds up to some real weakness in the labor market, and I think we'll see a continuation of that.
Laura, great to have you on the show today. Thank you.
Thanks so much.